Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to a thought-provoking episode of the What Matters podcast. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And today we have a special guest, Matt Liebman, founding partner and CEO of Amplius Wealth Advisors, where clients are at the heart of everything they do. Prior to founding Amplius, Matt co-led the Liebman Marks Group at Merrill for 13 years. And before that, in the investment management industry in New York City in a variety of roles. Matt has considerable experience with high net worth families and provides a unique approach to guiding clients towards their financial goals. Matt, welcome today. We really appreciate having you.
Thanks for having me on, Mike. Hi, Ashley. Good to see you both.
Great to see you today, Matt. Matt, let's delve right into your story and your journey. So you've had a diverse career in finance, including roles as a research analysis, portfolio manager, hedge fund manager. You know, what prompted your transition from the bustling streets of New York City to then founding Amplius Wealth Advisors back in Philadelphia in 2021?
So I actually came back to Philadelphia from New York while at my prior job at Merrill Lynch. And I think part of the move from, let's say, the institutional and hedge fund world in New York to the wealth management world was a desire to have more of a connection to the end client, as opposed to, there are a lot of money managers that do wonderful work, but when you manage money for a fund of funds who then has sub funds underneath that may have a pension fund or an institution underneath them, by the time you get to the final end investor, you don't really have much of a rapport and relationship there. And I wanted to get more face to face with the actual individual people that we were managing money for. So we did that I was at Merrill, as Mike mentioned, for about 13 years. And then 2 years ago, we decided, 2.5 years ago now, decided to make the full leap to owning our own RIA and fully an independent enterprise.
Oh, really cool.
Yeah, it's fascinating. So what were some of the initial challenges that you might have encountered when establishing Amplius, and how did you overcome them?
So anytime you're starting a business in any industry, you're going to have challenges, because you go from sort of being the practitioner to being the practitioner and the owner, we had to, first things first, transition all of our clients over, or all the clients that we thought were the right fit for our new model. But before we even got to that, it took well over a year of preparation with our colleagues at Dynasty Financial Partners that helped us a lot in terms of setting up the enterprise, figuring out our brand, our marketing, all of our back office, who our custodian was going to be, our investment platform, just about a checklist of about 300 some odd tasks over the better part of a year. Then it was a matter of transitioning our clients, and now actually, running the business while still managing the client relationships and the portfolios.
Oh, wow. So let me ask you this. When you guys had decided to leave Merrill, I know with some of the wirehouse individuals, they'll pay a sum of money to keep you there, right? And I don't know if they give it every year or what have you. But was there any type of lockdown that they had with you guys there? Were you allowed to take your clients, or was there what we call a breakup fee?
Right. So there are a few different parts there. So my former employer was, and I believe still is, part of what they call the protocol in our industry, which basically means that you can contact your clients so long as you only take a very specific set of information about the client. So we stuck to the protocol very tightly. And then in terms of, we all did have various forms of deferred comp that we would have to leave on the table. So not necessarily, Mike, a full-on breakup fee, but there were definitely some economics that we had to factor in that we would be leaving on the table, just like any other employee of a firm that has some form of deferred comp as part of their benefits.
Oh, wow. So Was there any, challenges you think with moving the clients when you said, hey, we're opening up our own firm, moving your book over? Were there any that were, not sure about wanting to move with you? Or do you feel like most of your clients, were excited to take that journey with you?
Definitely some challenges. I won't pretend that it was like just the smoothest and easiest couple months of our life. We worked quite hard during that period, but essentially, when you have a lot of passion about what you're doing, we were so convinced that what we were doing was the right thing for both us and for them. It made telling the story a reasonably easy, not only easy but exciting venture to do that. And then in terms of the clients coming over, you never, I don't know that anybody gets exactly 100% of every single person you thought going in, but we were pretty darn close. Most of the client, we didn't ask every client to come with us, but most if not almost all of the clients that we asked did come with us. And it is a challenging time because not only do you have to tell the story and make sure that the clients are comfortable, but you have two other hurdles, one being a little bit of a Jerry Maguire type experience with people at your old firm, your old colleagues, giving them a call and telling them why it'd be better to stay around, which is fine. And then finally, once the client does agree, which happened pretty quickly with most of our clients, there's a big operational lift. Both the clients have to fill out a lot of forms. We have to process a lot of paperwork. It was sort of all hands on deck for that, let's say, 2 to 4 month period, getting everything set up.
Perfect. So Matt, within going from Merrill Lynch to your own firm there, what are some of the entrepreneurial learnings that you took having worked at a place like Merrill Lynch and then going into your own practice? What are things that you took from there, and what are things that you do differently?
So I think the thing that is most similar in the business, no matter whether you're an employee at a big private bank or wirehouse firm, fully independent or somewhere in between, at the end of the day, it's really about people and money, and the client themselves has to be front of mind at all times. So that regardless of where you work. What I found here though, and being an entrepreneur and a business owner, what it allowed us to really do is not let anything muddy that focus. We were just, I always refer to it as the sort of who's the boss business model. That when you work at a big firm, when you're an employee, you have a manager, they have a manager, then there are banking managers, and then of course there's the executive team, the board of directors, and ultimately the shareholders. That's a lot of different agendas. When you own your own RIA like we do, there's really only one agenda we need to focus on, and that's the agenda of our clients. So I think that to me is the main distinction, and where we really focused when we moved from from employee to entrepreneur.
Real cool. So one more question I had there, and when you were moving over, when you were moving over your pipeline there, and you said something about there was specific information that you can take from them and what you can't take from them. I would think the most important information would be when you're taking them over as a client, right? What would be more important than that, right? When if you're taking them over, what would they not want you to have?
Oh yeah. No. So essentially, when you're an employee and then you leave the firm, whether that's to go to another firm, to go to an RIA, as long as you're part of this protocol, as I mentioned before, basically, in so many words, you're allowed to take with you the client's contact information. So you can contact them and just ask them, effectively tell them what you're doing and ask them if they would like to come with you. You're allowed to do that. And that's, and that's what we were able to do there. There's no more like you're not allowed to take, client statements, financial plans, all that kind of stuff. The client, can furnish that at a later date if they so choose, or you just rebuild that. But you basically just took the client contact information.
Oh, gotcha. Kind of like Trump and Biden weren't allowed to take their documents from the White House.
Yeah, I mean, well, I'll leave that one there. There's plenty going on that department right now. So,
well, Matt, Amplius Wealth Advisors has grown significantly over, just 2 years ago. You guys are well over $1 billion right now in AUM, if I recall correctly.
That's right. That's right. And somewhere probably in the neighborhood of 1.2, give or take.
Wonderful. So, can you unveil for us and our listeners, some of those strategies that you think really contributed to propelling your firm to the top in so little time?
So, number one, I think it's always about, as I mentioned before, people and money. I think it's always about making that connection with clients. But what was different now, or what is different now, is that we are business owners as well. So that's a really natural and easy connection point you can make to your business owner clients and prospects. Because in a lot of ways, while industries are different, the entrepreneur, the business owner goes through a lot of the same things. So I feel
Right.
that in that way, we are a lot more relatable now. And then I think you get another uptick in business. I think from what I'll call sort of natural enthusiasm that we're all really excited about what we're doing here, and it's new and it's fresh. And I think that came through to our clients and led probably to some more introductions and referrals than we otherwise would have had. And then and then the other thing is on this side of the world, we can actually do some marketing, some brand awareness away from just what the big firm is doing, and we've been pretty active with our folks at Dynasty and outside consultants and so on, getting our brand and our message out there.
And what made you guys come up with the name Amplius?
So we went through a fairly thorough process during that give or take year that I mentioned when we were prepping for the firm with our outside marketing firm that worked on all of our collateral materials and such. And what they do is they put you through a fairly extensive process about what matters to you, the business owners. Like, how do you view yourselves, your business, your clients? And where Amplius came from was the idea of doing essentially amplifying our focus on the clients, doing more, going above and beyond for our clients. And that's, it's really, they call it a curated Latin word, which is sort of another way of saying we made up a word that kind of looks like amplifying our focus on the clients. But we'll call it curated.
Now, at Merrill, were there rules and restrictions on, on placing your clients' wealth? Was there like a pretty, I'd like to use the word conservative structure that they had in investing, or different than what you guys are doing now?
Yeah, look, we're reasonably conservative by nature, just our team. But I'd say when you're at a big firm, you're right. They do have essentially a platform. They are the gatekeepers to a platform of investments that are available to you, the advisor, that you can put your clients in. Depending on the firm and the situation, you have varying degrees of autonomy and latitude as to how you want to position clients. On this side, we do have an investment platform as I've mentioned before, the Dynasty is curated for us, but we have really access to more or less anything we want to put our clients into and anything our clients want to be invested in. So it gives us, there's a lot more choice now, but with choice comes a lot of responsibility because you don't want to make the wrong choices. But certainly we have let's say a wider universe of potential solutions now for sure.
Oh, gotcha. Really cool. And let me ask you this. When you guys had made the move over from Merrill to Merrill to Merrill to your own firm there, was it just you and one other person, or obviously you guys can't take anybody with you if you're I'm pretty sure that there'd be some sort of a non-compete there. How many total advisors do you have, and how many people did you start the firm with?
So we started the firm with 8 people total, one of whom we knew was going to retire pretty much in our first year. He retired in our first year. So we were at that point 7. But we have done a lot of hiring in our first 2.5 years. So we're back up to 12 people, which is basically the maximum size we ever reached at our employer. But yeah, we have 12 people here now total.
Gotcha.
Wow. Prior to the private equity space, I was in the mortgage business for 27 years, and
wow,
it's the most labor intensive human capital business that you would ever encounter. Ashley worked with my brother and I at our company. And I think at one point we had around 1,400 employees. I mean, there is so much paper pushing and communication. It was unreal. And that's why I really enjoy this space because, 20 employees is probably the maximum I think that we're ever going to get to in this space. So I really like having, less individuals to deal with, have deeper connections and relationships with them. And yeah. So
No, totally. Yeah, we are a pretty cohesive team, and we've integrated the new people that we've brought on over the last couple of years. I think quite well.
Really cool.
And how many of those 12 are advisors?
Right. So we have, of the 12, and get into a little gray area in people's responsibilities and so on, but let's say 8 of the 12 are client-facing and advice-giving professionals. I could see an argument of anywhere from 6 to 10 because we have 10 fully registered, but let's say about 8 are actually on the front lines of advice giving.
That's great. So Matt, you've been recognized by Forbes as one of the top advisors in Pennsylvania, listing you as the best in-state wealth advisor in 2020, 2021, and 2023, if I recall correctly.
Yeah, we had to skip 2022 because we had just launched our new firm, but not to say I would have been. You never know.
Congratulations. That's quite the accomplishment. So with that, how do you measure success as a financial advisor?
It's a really good question, and it's hard to put one metric on it because you could have business metrics as a business owner, you could have investment metrics in terms of performance and so on. But ultimately, and this will sound like a little bit of a fuzzier answer, but ultimately, I measure it by client satisfaction. And what I measure client satisfaction by is essentially retention. Are your clients staying with you? But beyond retention, because inertia can play a role there for any firm. But are your clients introducing you to their friends, their families, their coworkers? And to me, that is sort of the stamp of approval we're looking for.
And do you feel like most of your new business is from referrals, or is that from your team's marketing efforts?
Combination. There are some members of the team that do a little more direct contact with prospects. We do have a lot of marketing and branding out there now, but a good chunk come from introductions from existing clients or centers of influence, be it attorneys, accountants, etc.
Gotcha. And let me ask you this: as a I would say, like as a leader in the RIA industry, what kind of fundamental leadership lessons have you learned that you would share to other fellow leaders that are maybe looking to make a move from a wirehouse like Merrill or Schwab or Goldman?
Oh, so unique in our business if you're looking to make that move. I think number one, go slowly. Due diligence. It's not for everyone. But I do think, and I feel strongly about this, or we wouldn't have done it. I do think it's a better business model for both the advisor and the client. So I think, so it's hard for me to say on one hand, go slowly because it may not be for you. On the other hand, it's better. But that is how I feel. It's not, it's not for everybody. But I do think if you have really strong client relationships and you're a very cohesive team, and you really want to grow, because to me, growth is a part of this too. I think that is part of the due diligence process, determining if that describes you well. And then from there, I think ultimately the number one piece of advice I would give to any entrepreneur, wealth manager, leader is listen. Listen to your clients, listen to the industry, do some reading, do some research, and listen and learn. Rather than, I think in our business we have a tendency, which I'm doing right now, of talking too much. But I do think listening is the way to go there.
Well, it was like I was explaining to my brother last night. Because he was asking, what questions do you guys ask on the podcast, and how much talking do you guys do? I said, that's the one thing. The podcast is not about myself and Ashley, right? It's about you. So you talk all you want, right? Because it's your moment to shine, right? Well, we're here to learn. That's what this is about. And
I appreciate that.
Had there, you said what year was it that you were moving all your clients over?
We launched in early 2021.
Okay. Oh, wow. Okay, so you had this huge uptick year, right, in 2021, and then 2022 was just a bloodbath, right? So,
Yeah, I mean, if you combine stocks and bonds, I believe 2022 is maybe the worst year for a 60-40 portfolio since maybe the Depression. I mean, it was pretty ugly from a market standpoint. So yeah, not for our first full calendar year, not the welcome we were looking for, but it's part of the business.
okay, so, so not that I heard that, I felt that, right? Yeah, I tell
Yeah.
this story. I tell this story often, probably every other podcast. Um, but my rule that I have with my financial advisor was I said, don't tell me how much is in there until it's back up to the amount that I originally invested with you, because I would seriously get massive anxiety when I'd have my once a quarter meeting with her, right? Um,
No,
so
I mean, it's you mentioned that, but I do think, and that's why I always when we talk about the business and we say people and money, I always say the people part first, because it's a behavioral business, and both from the perspective of the advisor and the client. So I fully relate to that, Mike. I hear what you're saying there.
Well, right, because I bet you in 2021 you probably had exponential growth for them. 2020 and 2021, obviously, you had exponential growth. Maybe let's just say that you had, I'll call it. I'm just going to pick a number: 40% growth or 30% growth, and then in 2022 you had a 20% decline, but you're still up 10 or 20% over the 2 years. They'll never pat you on the back for what the gain was, but you'll always you'll always get a bastardized for what the loss was. So
Yeah, I mean, I think over the years, building the relationships we have with clients, they're pretty measured, in their not look. Everybody's human, so you're right, and we always say the losses feel more painful than the wins feel great,
sure.
and that's human nature. But I think most of our clients, yeah, we congratulate them really that they kept a level head through what were, as you mentioned, really challenging times last year.
Yeah.
Yeah, so shifting gears a bit, looking ahead, what does the future of wealth management look like from your perspective, Matt? Are there any specific trends or technologies or strategies that you really believe will shape the industry in the coming years?
Absolutely. I think a few things. I'd focus maybe on demographics and technology. So on the demographic side, not only are clients aging as the population ages a bit, but advisors are aging. There are many advisors. I think I saw something. The average age of a financial advisor now, I don't know if it was late 50s, early 60s, but it was not what you would generally consider as super young in the field. And it's somewhat of an advantage that we have because we have a lot of younger folks on staff. But beyond that, so like you figure you have all these people potentially retiring or getting to retirement age, client side, so that's your demand, but you have a shrinking supply of advisors to service them. That creates a lot of opportunity but a lot of challenges for the industry. So I think really it's going to be the firms that are able to get that next gen talent to really scale up their business that are likely to win. The other piece, though, the technology side, is there's so much innovation in fintech, wealth tech, all of it, whether it's investments, planning, et cetera. And there are so many ways to sort of improve the services you provide for clients and do more for them, or amplify, to use to use our word there, that I actually think it's a bit of in just my opinion, a bit of a disadvantage to be at one of the bigger firms, because it's really hard to put in new technology across 15,000 people, 20,000 people. Like Mike, you were talking about having
Right.
thousands of employees before. I think at a firm like ours, we can be a lot more nimble to take advantage of a lot of those innovations. And that's where, and so I think getting back to your question, Ashley, over the next few years in the wealth management space, I think you're going to see a continued move from people from big firms to more entrepreneurial avenues where they can really customize a more bespoke experience for their clients.
It's a great point there.
And to highlight on that, I like what you said about the integration, because for us, we actually, how many loans did we service? Was it around a 400,000 or 500,000 at one point?
Yeah.
Wow.
Yeah, so we
Yep.
we owned the servicing rights on 500,000 loans, and so I remember one of the biggest challenges was switching tech platforms, right? It was an enormous disruption to the industry. Well, to us as a company, and so I can understand what that's about. And let me ask you this: obviously, in growing your company and having your advisors, and the future of your growth, how do you guys do it? Organic, inorganic? Are you bringing the kids out of college and saying rather than going to the Edward Jones, come to us, or how are you guys doing that there?
It's a really good question. I'd say it's evolving to answer your question. So I think from the client perspective, thus far, we've exclusively been growing organically. We have not acquired, other firms, which is something that a lot of people in our business are doing, and we are
Yep.
open-minded to. But it's not a direct focus right now. So that side, thus far, has been organic, but we have an open mind. On the hiring side, we want to bring talent onto the firm, whether that is right out of college. We haven't done that much, but we've hired people a few years out, in their 20s and so on. And we're going to keep looking for talented people to add to the firm, because if and that's another advantage of running your own firm, is you get to decide who you want to hire, who you want to bring on, and so on, and at what pace. We don't want to go crazy and overhire, but at the same time, if we have people that we think are talented enough to add value for our clients, then let's get them here.
Right.
And once you get them over, and I think I've learned this myself, right? Um, you know, the it's a lot different these days than it was. I mean, I would say probably back when I started my first company in the mortgage space in I think, my brother and I in 2001 or 2002. We would hire individuals there. We met off Craigslist, right? And these individuals were still with us in 2011, 2012, right? Um, and come this new wave of growth that had happened come 2000 probably 14. I mean, it was tough to keep these individuals around for 7 to 10 months. As soon as they learned, they got licensed, and then they were off to the next company that was paying them more, right?
Yeah.
Because obviously, we pay a little bit less because we had 7 or 8 months of grinding and teaching them, a cost to the company where they weren't making the company any money. I don't have to get into that with you. But once they learn, they take off, and it was we had to retool everything. I kind of learned that waiting a few years, letting them go get hired by the one or two firms that they could cut their teeth on and learn, and not feel this firm's better, let them go get beat up a little bit by those other couple firms, and then settle with us, right? So I kind of made it like, well, how many jobs have you had after college, or or after you got your trade done, or what have you? And I would make sure that they had at least two other jobs, and that they were there for at least 2 years apiece. And I would
Oh,
verify it.
interesting.
Yeah, because I couldn't handle, once they got up and running, they would just bounce. And maybe that's the way that's the difference in the industries, and why I like this industry so much more. But have you experienced that? How do you get these guys and gals over? How do you get them to stay? And I know the wealth management space is a little bit different, but share your insights there, please.
Yeah, so there's a lot there, and a couple specific challenges that I think our industry faces right now is, even in the RIA world, let's say the most independent part of the wealth management industry, where we are, most of the people that I have encountered here, and maybe this is incorrect, but this has been my experience, didn't just start one day, hang up a sign and say, I'm an RIA, bring your money over. Most of them started at a big firm and then split off. So most of the training, to your point, Mike, was, happened at the bigger firms. And I think, given where the focus is now at the big firms, I don't think that they want, as a business model, hey, let's hire a bunch of people and train them so they can go start their own businesses elsewhere. That's not a great business model. So my guess is that's not going to be the world they're in. And you've seen that, as a lot of them pulled back their training program. So the question is sort of, how do we fill the gap there? Those over here to really grow this side of the business. One thing that we're trying to do in terms of retention. Obviously, the best thing you can do in terms of retention, beyond obviously compensating well, is hiring well, finding people that you think are a good long-term fit. But that's a little art and a little science. But one thing that we're focused on that's maybe a little unique to our industry is historically, and it was like this when I came in, when Aaron, my partner, came in, and so on. Historically, at the big firms, to make it as an advisor, you had to be able to sell. So you had to be able to go out and get business. And what you can find over time is someone could be a really good salesperson, but not that great of an advisor, or vice versa. Someone could have the talent to be a fantastic advisor, but they can't necessarily go out and get the money to advise on. So what we're trying to do is bring people on that we think are going to be very talented advisors, and not put it on them to go out and get business. You're not a salesperson. You're an advisor. And do your job, be a good advisor. We have a lot of confidence in you to do that. We're not giving you hurdles, raise this much money by this date. That's not your role. If we did want to bring on more business development people, we would give them hurdles like that. But for the people we're bringing on as more relationship and advisory people, we're not also mandating that they go out and bring in business. If they do, great, but that's not their primary responsibility.
Wow.
Yeah.
Well, I really like that. I was always blessed to having a twin brother. So, I'd like to say, that God gave us different talents, right? And I always loved sales, and it was something that came easy to me and I was passionate about. And although, Darius is a great salesperson, he thrives much more with the back end. So me bringing in the business was very, very easy in any capacity of business that we've done. And then controlling and handling and building the business from there was his expertise.
So you complemented each other well. Yeah.
And we never crossed. We always had a rule that we'd never, get into each other's lane unless there was other business partners that we had that would, kind of had a problem with it. My brother's really good at technology, right? He understands technology very well. Even my term saying really good at technology, I would say tech savvy, right? And I'm horrible at it. As you can see, Ashley had to come in just to click a button for me, right? We had to stop the podcast for that. Ashley, that button doesn't exist here. She comes over. She's like, "Oh yeah, it was right in front of you."
Story of my life.
To say there, what Darius had done years ago was in the middle of us getting some loan officers going. We hired like 20 of them or 30 of them. We switched technology for all of them, right? And I kid you not, half of them quit on us. They're like, you know what? We just got up to par with the last piece of technology that we brought in, and we're changing it now. And granted, it was 2009 when this happened, and the industry was pretty shaken up. But I think that was the last thing that they said that they were gonna put up with, because a lot of people that are more geared towards sales, our mind doesn't really gravitate to the changes of technology, right? We almost see it as a burden rather than something that we're good at. So.
For sure. I mean, I shouldn't say no one, maybe somebody does, but most people instinctually do not love change, and so, but it's a fact of life, and we're trying to take advantage of it as much as possible, especially on the tech front.
So before we, I pass the mic off to Ashley here. When it comes to change, and I know that the RIA industry is, as stable as it is, right? And the wealth management space, as stable as it is, there is a lot of change. I mean, obviously, look at 2022 and then 2023. Nobody has a crystal ball there. If you would have asked anybody what this year was going to look like, I mean, I studied the market pretty avidly, and I could tell you that everybody thought this year was going to be a bloodbath as well. And I mean, look what happened. I mean, I think the stupidest thing most people could have done was taken their money out and then shoved them into treasuries, right? In the beginning of this year, right? And that's what I know a lot of people were really gearing towards. How do you handle all that when it comes to the ever so changing market in this space?
So my research background before getting into wealth management was in asset allocation. So effectively, how much of your money you should have in stocks, bonds, U.S., foreign, large, small, etc. And we are very disciplined along those lines. And part of being disciplined is knowing that when something's flying way up, you're going to leave a little bit on the table because you're not going to have like your whole portfolio in that. But when that thing, I would say almost inevitably, not everything inevitably falls, but a lot of things that go up fast come down almost as quickly. You don't own as much of them. So for us, from a portfolio perspective, it's we always say, like, let's when it comes to the investment side, we want our clients to do well, but investing is not supposed to be a game. It's not supposed to be gambling. It's not supposed to be exciting. We prefer something that, let's call it, a little more balanced and boring. And I think that helps serve us pretty well over years like last year into this year, which, to your point, have been wildly different from one another.
And one more question I had there. When you said that there was the biggest or I wouldn't call it the upset, but obviously fixed income and equities were both,
Yep.
diving last year. What was the what was the cause of that? I mean, I've gotten different opinions from different individuals, and that's happened 4 times in our history, I've been told, or something like that. I could be wrong.
Yeah, so the return of the bond market last year in particular is what was really, an outlier. Stocks going down, whether it's 15%, 20, 30, as you know, that happens every couple of years on average. And but what you usually don't see, especially not at a time that stocks are also selling off, is bonds getting hit that hard. And I think it was the worst year on record for bonds going back, decades, if not longer. So I'd say the number one cause, from my perspective, was the Fed raising rates. You essentially went from, and that's not blaming the Fed, I'm just saying that you essentially went from a zero interest rate policy for the better part of, 15 years, 14, 13 years since the financial crisis, to the Fed fairly aggressively raising rates to try and rein in inflation. And that reset risk in a lot of assets, be it real estate, stocks, bonds, you name it. And, and I think the second piece to that is, with interest rates at zero for as long, or near zero for as long as they were, some valuations got out of line. So, some things were being valued on a rosier future than was really realistic. And you put those two together, you wind up with a pretty lousy year as prices reset and risk management becomes important again, as it almost always should be.
Yeah, because I can tell you one more thing here. In the mortgage space, as a mortgage originator, you want rates to go down. As a mortgage bank, which we were, we had I think at one point close to $100 billion in assets, and when rates would go down, it was the worst thing for us because our portfolio runoff. I remember some days we would get 1,000 payoff demands in. Right.
Wow.
1,000 people refinancing out of our portfolio. Right.
I believe it. I mean, it's a very rate sensitive product, certainly. So I believe it.
I said that's why I like this space, because in this space you never get a couple $100 million a day, just telling you sayonara, right?
I'm knocking on wood that has never happened to me, and I hope it stays that way. So.
Matt, so let's go into a little bit, like, what does the future hold for Amplius? What are, your aspirations for your firm? Do you have any, goals for the next 5-10 years?
Yeah, certainly targeted, responsible growth. But I would say that's secondary to, let's just do the very best job we can for the clients we have. Let's keep getting better. We always say here, complacency is the enemy. So let's just keep getting better at what we do. Let's have happier, more satisfied clients. And I think they're reasonably happy and satisfied now, but let's make it better. And then from there, let's get more clients as a result of that. So it's sort of, for us, it's sort of, treat the people you have now, whether that's employees, clients, as well as possible. And in a lot of ways, the growth will take care of itself to a degree. Now, from there, do we, more strategically decide to get into other lines of business? I doubt it. I think we are more of a, wealth manager. That's what we enjoy doing. That's what we think we add value, but we always will keep an open mind. Similarly, and we spoke about it, before, this whole idea of inorganic growth, that's totally new to us. When you're an employee at a firm, you're not like, well, I'm going to go out and buy another firm. Like, you don't have the power to do that. And now that we actually own a firm, we do have the power to do that. We have been approached even since launching by many firms on the buy and sell side. And, we've had conversations, but we're generally resisted that so far because we tend to be a little deliberate and gradual. So Long-winded way of saying we want to keep doing a better job for our clients, stay laser focused there, keep growing, but keep an open mind to this new world that we have entered here.
Real cool.
Yeah. And for someone who's deeply involved in the financial industry, what investments and sectors are you most excited about at the moment?
So right now, and I'll throw the caveat that all investment decisions should be made with one-on-one conversations with your advisor. So I'm not recommending anything specific,
Disclaimer.
but in general, going back to our balanced and boring philosophy, we tend not to get overly concentrated in one area. We like to be very diversified. Our general feeling is if you have a sound financial plan and you have a disciplined portfolio, all you need then is time. So let the markets work for you over time. That said, going back to something Mike was mentioning before, one area that I'm more optimistic on now that I have been in, 15 years, is short-term treasuries. I mean, you can buy a short-term treasury and get 5.5% interest right now, give or take. You haven't been able to do that since, I think today I saw the 2-year treasury has the highest yield since 2006. That was a long time ago.
Is that because of the inverted yield curve?
Well, yeah. So essentially, the Federal Reserve has raised rates, which have brought rates up across the curve, but they've gone up a lot sharper at the front end of the curve. You know, the 6-month, 9-month, 1-year, 2-year have gone up more than, let's say, the 10-year or the 30-year, though those areas are starting to catch up. So I'd say, I guess, keeping with the theme of Matt's boring, let's go with short duration treasuries. I like right now, and we're always going to own equities and stay diversified for our clients, but right now, if there's one thing that jumps off the page, it's maybe what's traditionally the most boring asset out there actually looks appealing for the first time in almost 20 years.
I'm so happy you said that. Yeah. First off, you're not the first person that's told us that even this week. And secondly, selfishly, I'm happy you said that because I've just, diversified 50% of my portfolio into short term.
Okay. Well, then, yeah. So we're either going up or down together there, Mike. So
given your expertise, obviously, what do you think is in store for the economy? You got you have the inverted yield curve. You got this the most amount of debt that we've ever seen. You got the presidential election coming up next year. What do you think is in store for the economy? And can you provide some expert insights that will help listeners make more informed financial decisions?
So in terms of what we see with the economy right now, and I won't claim that my crystal ball is clearer than anybody else's. It's a murky world out there now. And as you said a few minutes ago, Mike, a lot of people were caught off guard both last year and this year by market movements. One thing we said over a year ago now, we thought that we were in a period of what we called volatile mediocrity. That essentially you'd have kind of, whether it's the economy, the markets, kind of good quarter, then bad quarter, and things look good, then they look terrible. And when you take a look back over a longer multi-year period, you didn't get very far. And we kind of still think we're in mediocre times right now. We are not necessarily predicting doom and gloom, though sure we'll get a little bit of doom and a little bit of gloom because you always do. But we also don't think these are boom times. We think that these are going to be sort of mediocre times that you kind of had this, hopefully once in a, I don't know how long, let's say once in a century financial crisis in 2008. I hope it's not more frequent than that. And then the government, both here and around the world, tried to really get us out of that for the better part of a decade with the zero interest rate policy. And now that they're resetting, I think we are in a little bit of a new world right now. And that new world to me will be, as I said, a fairly mediocre one. In the more short term, I think you hit the nail on the head. The election next year is, for lack of another term, we'll call it unique, and I think that could cause some anxiety in the markets as well. But in general, our outlook right now is pretty darn mediocre. We're not overly optimistic or pessimistic right now.
Real cool.
Well, thank you so much, Matt. It's been a pleasure talking to you today, and we really appreciate you sharing your insights and financial wisdom with not only us, but our listeners. And it was great hearing your story. So thank you again for joining us. It's been a pleasure.
No, my pleasure, Ashley. My pleasure, Mike. This was great. Thank you.
Thanks. And to our listeners, stay tuned in for another episode of the What Matters podcast. Stay curious, stay informed, and join us next time as we explore the exciting world of wealth management and financial innovation. Thank you, everyone.